We're going to talk a little bit today about, next slide, Beth. We're going to talk a little bit today about gambler's fallacy, aka the hot hand fallacy. And we are so anti-trend here, this should be easy for us, but can be described as the belief that a trend will continue to revert based on previous occurrences of independent events. And we all know, how many times have you used the term gambler's fallacy?
A lot.
A lot.
A lot.
Especially when we're in Vegas.
Yes.
Especially when there's six banks in a row and you're betting.
They used to just say, "Oh yeah, sure, you know," but it's gambler's fallacy.
Especially when we're playing roulette and we get about 5 reds in a row and we're like, well, you got to bet black now. As a premium seller, the worst thing we can do for long-term profitability is fall prey to a gambler's fallacy, or in other words, throw out the mechanical playbook. So this brings us to the question, why win or losing streaks don't change the math? All right?
Yep.
So to get a clearer picture, let's start with some scenarios illustrating the gambler's fallacy. Stock's been up for the past week. I think we'll see a continuation on Wednesday. The roulette ball has landed at the same thing here. On black, the past 5 spins, I think it's going to be red. I have 3 children, all girls, and I think the odds are in favor of number 4 being a boy. Or the market's gone up for X number of days, weeks, months, years. We're at 18 years, boys. No, actually, we're at 16 years right now in a row. So it has to fall. These are all fair questions.
Sure.
So here's our study. We used the SPY for the last 10 years. 16 delta strangles, 45 days to expiration, managed to 21 days, and held to expiration. We did them both. Computed the average P&L, win rate, premium collected, worst loss divided by buying power, and the volatility of our P&L. Since short premium trading generally has a positive expectation game, you win in the long run. Where can the gambler's fallacy hurt you? That's my question, Bat. Where does the gambler's fallacy hurt you?
The bid-ask differential. There is no theta decayed opponent.
Nope. Where does the gambler's fallacy hurt you? And it's funny because I did an interview with somebody yesterday. You guys are going to see this coming up pretty soon. And the person I did the interview with
nailed it.
No, the gambler's fallacy came into play. It hurts you when you double up to catch up.
Okay.
It's when you double and triple up to catch up.
Sure. Not something I do, but I get it.
Something I did in a past life. Mm-hmm. Double up to catch up.
Now, on the offensive, 2 becomes 4, 4 becomes 8, 8 becomes 16, 16 becomes 32, 32 becomes 64, bat, we leave.
Nobody knows how to do the offense. There is no such thing as an offensive. It's like 1, 3, 5, 3, 7, whatever it is. That's just, that's pressing it. The only people that press things really well sometimes are momentum traders and craps players. So let's consider a fair coin. You flip the coin 10 times, the results are below. One might erroneously conclude that the next flip will favor either heads, gambler's fallacy, or tails, reverse gambler's fallacy. However, the outcome is due to chance. The probability of the next flip being heads or tails is still 50-50.
And when you can realize and learn that, you'll be a better person. It's 50-50, each occurrence.
Nope, I'll still take. Nope, if I saw this.
That's why you should do it with your eyes closed. Like, it makes no difference. It's just a guess.
That's why I'd still choose tails here. Mm-hmm. Let's go to the next slide. Because can't get out of your head. But here's the good stuff. So managed to 21 days is blue, and held to expiration, which obviously we don't do held to expiration because we're out at 21 days. But
when you said, you know what, now that I think about your gambler's fallacy, you're saying doubling up. I should have thought about that because that's just, you said it's increasing your size, but we know increasing your size is when things go wrong, regardless. Yeah.
So let's consider the results of 16 Delta SPY strangles, 45 days since 2015. Each trade managed early and also held to expiration. And you can kind of see here, you can see at the blue is managed to 21 days. Red is held to expiration, and the you can just see how much more. Like the big one is the volatility of P&L, but you can kind of see how similar everything is, except in most cases, the blue just protects you, just reduce your risk.
Yep.
Okay, that's all it is. It's just a reduction of risk. It's a reduction of risk. It's an increase in dollars. It's an increase in dollars per day and a reduction of risk. So now let's say that our past 3 trades are losers, averaging a negative $100 per trade. Does this mean that you should place, and here's the answer to your question, does this mean that you should place a larger position next time, expecting that your P&L will revert back to 10 years average of 34 positive dollars to 78 positive dollars because selling strangles has a positive expectation? And so whether you manage early or hold to expiration, it still has a positive expectation at the end. So do you, if your last 3 trades were losers, then does that mean you should place a larger position?
No.
No. Next slide. He's a fast learner.
Nothing gets past me.
So this is one of the fun ones that we've done in the past. Blue, 1 contract, whatever color that is, turquoise, 2 contracts.
Fuchsia, you would look at.
Yellow's 5, and I guess that red is 10 contracts. So the answer is no. And actually doing this implies that it exposes you to more risk, while the probability of profit, the win rates, and the premium collected, and the worst loss on this hypothetical trade all remain the same. So everything else remains the same, except you're just exposed to a crap load more risk. And this graph shows the results when you hold to expiration. You can just see your risk goes up. That the middle one that's out of control, if you can't read it on the slate, is the volatility of your P&L.
That's correct.
Okay, and that's where the risk just explodes. Volatility of P&L.
That's what
payouts the same.
That's what hurts.
Average P&L is the same. Payouts. The premium's the same. The worst loss and the win rate, everything remains the same, but the volatility of your P&L explodes. Let's go next slide. And then looking at this slide, when you manage the trade at 21 days, the outcome remains the same. This means that increasing your position size in hopes of achieving a better result doesn't improve your probability of profit, your win rate, or the premium collected. It simply increases your risk exposure. And you can see it here, it's even more pronounced.
Sure.
On the other hand, by managing trades early, the overall risk and the worst loss are significantly reduced. So it's a really good example here.
Really good example. This was a really good study, just showing the magnitude of the.
Yeah, it's just clean. It's a clean looking slide. You save this one, you put it in your back pocket. Next time somebody goes, I'm going to go from 5 to 10 just because I got to win eventually. And that's also how they carry out of the casino.
Genius fails, a lot of things you can call it.
And that is, if you get a chance, read the book When Genius Fails. But if you haven't, that's why a bunch of Nobel Prize winners and Nobel laureates lost all their hedge fund and lost the money and almost took down the market because genius failed due to size. So just 2 quick takeaways. After a trend of winners or losers, there's no edge in trying to pick a direction on future trades since they are a matter of chance. And after losing trades, do not abandon the mantra of trade small, trade often, or managing your positions early as your probability of profit remains the same.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.